So in today's live stream, we're going to start by talking about the dollar, what the dollar is doing, and what we are anticipating to see in the marketplace. So a lot of people yesterday were asking how I do a top-down analysis. So, I'm gonna have to start from scratch from today's analysis, so everyone can be able to tag along and understand the full market breakdown, how I go from time frame to time frame, from the currency pairs that I first look at before going down to the other currency pairs, the reason why I'm looking for a buy or a sell. I'm going to outline everything. So if you miss out on this live stream, do try to go back to it and watch it because it's going to help you understand why we're looking for a buy and why we're looking for a sell. So today's live stream, I'm going to make it well detailed so everyone can be able to tag along. So the first thing I do is to look at US dollar index. That's the very first thing I do when I come into the chart and I'm looking at starting from the 12-month time frame. Yes, I can start from lower time frames, but the reason why I start from the 12-month time frame is because I want to have a broad view of everything that is going on in the marketplace. The reason why price came to the upside, the reason why it went to the downside, the reason we could potentially see a move to the downside or to the upside. I outline every single detail. Now, looking at the 12-month time frame, the first thing I look at is the key levels that price has retested and the key levels that price would potentially retest in the potential future. So the first thing I'm looking at is right here. We are currently within this range high and this range low, right? Now, what do I see above this range high? I see liquidity. What do I see below this range low? I see liquidity. Why are these key levels liquidity? The reason for that is because the institutions, the ones that are selling their stop losses, are going to be resting right here. And the ones that have been buying, their stop losses are going to be resting right here. So that is the reason why these two key levels, we have liquidity resting right here and right here. Now, nobody knows whether price is going to want to run this high before it runs the low, or whether it's going to want to run the low before it runs the high. Nobody has that information. All we're doing is trying to participate in the marketplace. So the first thing we do is to outline key levels where price could potentially come into. Now, the first key level I'm looking at is right here. We have this inefficiency. This inefficiency could potentially act as a drawn liquidity, a magnet to attract price to the upside. Another thing I'm looking at is right here is another inefficiency. Now, ask yourself, between this inefficiency and this inefficiency, which one do you think that price could potentially get drawn to the quickest? The answer is simple because I don't really even need to answer that. You've already answered it yourself because the one closest to where the current price action is the one that price will potentially draw to easily. Now, it doesn't mean that's a certainty that price will definitely draw into this one, but this one right here has a higher probability for price to draw into this key level more than this one. This one could be something we could be anticipating to happen in the furthest future. It could be in years. It could take years for price to come in here. But this right here could take days. It could take a few weeks. So it's just like imagine having a magnet, positive and negative, one's resting just a few meters from the other one, and then the other one's resting like thousands of meters away from the negative and the positive. You already know that if you're pushing the negative magnet closer to two of those different magnets, you will see that the one that is going to draw in the fastest is the one that is closest. I'm trying to describe this at basically the most basic terms. I'm trying not to use any ambiguous words to explain this because trading is already complicated business. Trying to use even more complicated terms to explain it is going to make you get more confused. So that being said, now this is our key level, drawn liquidity, and then another drawn liquidity right here. You can see this inefficiency resting right here. You can see this one right here, and you can see how nicely price used that as support. You can see how after we saw this expansion, price came into that inefficiency and used their support, this expanded higher, displaced down into that key level again, used it as another support, and then we saw this expansion to the upside. Now look at this as well. Now you can see that we have a high, we have a low, and then price rallied above this previous high, right? And after we rallied above this previous high, you need to take note that we've not closed above it yet. We've not confirmed a close above this high yet. So that means that we could still potentially come in back into this key level before a continuation to the upside. Now, that being said, now we've outlined our drawn liquidities, overall 12-month drawn liquidities being this and this. The next thing we do is we scale down to the 6-month time frame to see what's happening, what the market is showing us at these other time frames. And on the 6-month time frame, there isn't really so much to work with besides us seeing that the inefficiency here is really wide, and also seeing what we mitigated right here, which is another inefficiency. You can see that very clearly, and you can see how we mitigated that inefficiency and we dropped down, leaving wicks. So this was a significant key level to cause this kind of reaction. But now look at this key level. On the 6-month time frame, this key level is showing us that this was a break, a high, a low, a break. We confirmed a break right here on the 6-month time frame, but we've not confirmed the break on the 12-month time frame, which means that the 12-month time frame can potentially do a retracement to the downside. It's a potential possibility, but not a certainty, right? Now, that being said, another thing we're looking at is this week's right here. Now, to understand my analysis very well, I would encourage you to go through my models from the model 1 to the model 4. It's going to help you understand a lot of terms I'm using, even though I'm breaking it down more. But watching from the model 1 to the model 4 will help you even more, so that when I'm doing the analysis, the reason I'm outlining an inefficiency or a key level, you will have a good understanding of the reason why I'm doing that. So that being said, the next thing we're going to look at right now is we're going to figure out the discount and the premium positions. Where are we in the marketplace? And to do that, we use the Fibonacci. Right here, we'll draw a Fibonacci from the high to the low right here. If you're wondering what my settings for Fibonacci is, this is the settings. You can screenshot this and then you can set yours that same way: 0, 0 0.3, 1, 0 0.2, 0 0.5, 0 0.9, 0 0.8. That's all. So the Fibonacci is just a measurement tool. There's nothing special about the Fibonacci. It's just a measurement tool that I use to know my extreme discount, extreme premium, my premium discount, equilibrium zone. That is all I'm using this for. And right here, you can see this inefficiency on the 6-month time frame. Let's go back to 6-month time frame. You can see on the 6-month time frame, the inefficiency resting right here, also aligned with the extreme premium. So right here is the extreme premium. This line right here is equilibrium. Anything above it is premium. Anything below it is discount. Right here is the extreme discount zone. Now you can see very clearly price tapped into this extreme premium before we saw this displacement to the downside. Now, after tapping that key level, we didn't retest into a discount, right? Now look at how this aligns as well. If you're looking at the 12-month time frame, you see this is our discount key level, and look what's above the discount key level: inefficiency. Now, it doesn't mean that price will definitely come into this inefficiency, but this is also to show you that there could be a possibility for this to want to come into this key level. Number one, because of the inefficiency. Number two, because this is a discount key level, right? Now, what we work with is understanding what price has done, what price could potentially do in the future, and using that to determine where to look for entry positions, whether we're looking for entry positions to the upside or looking for entry positions to the downside. Now, look at another thing resting at the discount position, another inefficiency on the 6-month time frame. I'm also going to outline that as well. Now, it doesn't mean that price is definitely going to come into this key level, but it's something to also put into perspective, mark it out, and leave it and watch what price is doing. If price is showing us tendencies that it wants to come into that key level, we will look for entries to sell it into that key level. If price is consistently showing us that it wants to keep going up, we will look for entries to continue going up because we still have a drawn liquidity here and a drawn liquidity here. Even though this one is much closer to us, this one above here can also attract price to the upside, right? That being said, we scale down to 3 month time frame. We want to understand what's happening on the 3 month time frame. Price tapped into this inefficiency, resting at the extreme premium before we saw this displacement to the downside into this key level. Now, take note of what I'm gonna do right now. I'm gonna invert this chart, and the reason I'm doing that is because we want to look at this as a very different asset class. We don't want to look at this like this is dollar. We want to look at it like, let's say I just came into the market and this is just some random pair. What do I do? What am I looking for? I'm looking at this low right here. This is my key level. Let's say I'm looking for a break of structure. Price came into this key level, created a low, created a high, failed to create a lower low, failed to create a higher high, drop down breaking structure. Where is my key level going to be? My key level to look for price to come into the continuation to this position is right here. Right here is going to be my key level. If I'm looking for anything, if I want to engage in the marketplace, this is where price will offer me the highest probability in here. Now let's flip back the screen. And what do you see right there? The inefficiency that I outlined on the 12-month time frame, the 3 months, the 6 months, they all aligns with this key level. And look what's there. Liquidity. Previous low. Liquidity. Why is this low liquidity? Because a lot of institutions are going to be buying from this key level for price to continue to the upside. So their stop losses are going to be resting at this low. That is the reason this low is liquidity. When I talk about liquidity, I don't mean your stop loss. I don't mean my stop loss. Our stop loss are totally irrelevant in the marketplace. It's just like a drop of water in an ocean. The ocean is the institutions. They have billions of dollars in the marketplace. They are the liquidity. Not me, not you. We are not the liquidity. We are only market participants. So when price is running for liquidity, stop thinking they are hunting for your stop loss. They don't care about your stop loss. They are hunting for the institutional stop losses because those are the liquidity in the marketplace. Those are the billions of dollars in the marketplace. So that being said, you can see that you can see how price came very close to this key level, but it failed to tap that key level. What does that tell you? They are engineering more liquidity at this level. More liquidity is being engineered at this level. Now, it doesn't mean it's a certainty that price will definitely come into this key level, but it's high probability. Why is it high probability? Because we derived this key level using the higher time frame. And you have to understand that for these higher time frames to play out, it's going to take ages. It could take months, years. It's not something that is going to happen tomorrow or next week. It's going to take time. Every single candle on this chart right now is 3 months. So that means before price is going to come in this key level, it's going to take a minimum of 3 to 6 or 9 months. Minimum 3 months. Because each candle right here is a 3-month candle. Look right there. This is our 3-month time frame. Each candle is 3 months candle. So it takes 3 months for each candle to form and close. And it's going to take another 3 months for another candle to form and close. So if price is going to go to the upside or to the downside on this time frame, it's going to take it 3 months to form and close. Now we've derived our area of interest where we will potentially be looking for high probability buys on the dollar. What we do is we just leave that key level and then continue with our analysis to look for potential areas to look for trades. Now, another thing we can also do is to determine where this could potentially be. Our key level that we've outlined for our high probability buys, what is resting right there? You can see right here, extreme discounts. Anything below here is discount. And look, price came into a discount. That is why we saw this reaccumulation expansion. Now, what we do next is we're going to scale down to the monthly time frame. Now, on the monthly time frame, you can still see very evident price didn't tap into that key level. Now, you must be wondering, why did I not use this week's? Why did I not cover my key level from this week's to this low? The reason is because the volume lies at the bodies of the candles, not the wicks. A lot of manipulations are going on with the wicks. Your broker can decide that they want the wicks to be 100 pips, and my broker would decide they want the wicks to be 200 pips. They can manipulate it in order to run your stops. And when they're satisfied running your stops, they can continue taking price to where they want it to go to. But the bodies of the candle remains constant. That is where the volume is resting in the marketplace, not the wicks. The wicks is just an object used to manipulate price. Run your stop losses. Look at what price came here to mitigate. This was a stop loss resting right here. A lot of people, this is the reason why I always say it's better to have your stop loss at the overall high or the overall low. Never try to place your stop loss within a range, because if your stop loss is here, you would have gotten wiped out. If it was here, you would have gotten wiped out. That is the point of the wicks. They use the wicks to manipulate the market, run your stop losses, and then continue towards the direction they want to take the market. So that being said, now what we're gonna now look at is where are the potential key levels where we will be watching to see price come back into. Those areas are, firstly, we have an inefficiency here. Yes, price tapped into this inefficiency, but don't forget we still have this range untapped. We also have this inefficiency here as well. You can see that very clearly. We're already digging deep into that inefficiency. We're going to outline the inefficiency right here, make it a different color, outline the remnants for this one. So these are two key levels that could potentially attract price to the upside. And as you can see, this one right here attracted price to the upside, and we're currently in that key level. The next thing we do, we go to the weekly time frame. What do we see right here? Inefficiency, right? We see an inefficiency resting right here. Now, if we're looking for a trade, for us to say the trade is high probability, there are things we're looking out to see. The first thing is we want the trade to align with a monthly or a weekly or a daily or a 4-hour point of interest. For us to say that trade is high probability, it needs to align with a monthly, weekly, daily 4-hour point of interest. Anything lower than these time frames is not a high probability trade. It doesn't mean that it will not play out if it comes from 1 hour, 5 minutes, 1 minute. That can also play out, but it's not high probability. Now, the reason I'm saying this is because that a trade played out doesn't mean it's high probability. And understanding this, it's basically something that will help you when you are independently trading the market. So for example, right here, our key level is on the monthly time frame, right? The next thing we're looking for is an alignment for this key level to hold, an alignment of this key level with another time frame, either is the weekly, the daily, or the 4 hour. Once we see that alignment, the next thing we do, we scale to the 1 hour and see if the 1 hour is showing us any confirmation. If it doesn't show us any confirmation, that's still okay. The only thing it means is that for us to engage in the marketplace, we need to see a 15-minute shift in market structure. Now, that being said, the reason I'm saying this is because even if you don't understand how to read structure, if looking at structure and everything I'm doing sounds so ambiguous, so impossible for you to do, one thing you can basically do that will still generate profits in your trading is learning where the inefficiency is, working with monthly, weekly, daily, or 4 hour inefficiency, and then waiting for a 15-minute shift in market structure. Does that make sense? If it doesn't make sense, you let me know in the chat and I'm going to explain that in the next live stream. But that being said, now, this is our monthly key level, right? I'm going to use this as a point of interest, as an example. Now, we don't know whether this key level is going to hold for sales on US dollar or not. We don't know. But this is our point of interest. Now, the next thing we want to see is an alignment of this point of interest with either the weekly time frame or the daily time frame or the 4 hour time frame. We want to see this inefficiency align with one of these other big time frames. So how do we do that? We scale down, we go to the weekly, and on the weekly, what do we see? We see an inefficiency aligning with the monthly inefficiency. One, we go to the daily. What do we see on the daily? Another inefficiency aligning with the monthly, the weekly inefficiencies, right? The next thing we do, we scale down to the 4 hour. On the 4 hour time frame, we also see the inefficiency right there, aligning with the monthly, weekly, daily. So this key level is high probability. Now, what we're looking for now is other confluences that will align with the already generated confluence. What do we do next? We can pull up our Fibonacci. Like I said, the Fibonacci is just a drawing tool. There's nothing special about the Fibonacci. It's just a drawing tool. A measurement tool, pardon me, that was a mistake. It's a measurement tool. You use it to measure where the price has been and where it's potentially going to. Where it's been, the low, where it's potentially going to. Extreme premium. What is resting at extreme premium? Inefficiency from the monthly, weekly, daily, 4 hour. Do you understand how they all align with each other now? This is the reason why I'm saying this key level is high probability, but it doesn't mean that price will definitely sell off from here. It's not a certainty, but it's a high probability. Does that make sense? If it doesn't make sense, drop it in the chat and I'm going to review this again, trying to explain it in even more basic terms because I really want everyone to understand this, because understanding this is going to help you in your trading. So now this area becomes our key level to watch out for. So all we now look out for is for price to tap this point of interest. We put our alert right there. So we just sit on the sidelines, we do nothing. So you can see we're almost there, but we've not tapped in. So we go to the 4 hour time frame, look for the watts on the 4 hour time frame, and inefficiencies resting at the 4 hour time frame. You can see the inefficiency resting right there. So we don't know whether price is going to want to fill the entirety of the inefficiency or it's going to just want to tap in a bit. All we just do is to mark the entire zone. And then on the charts, if we are bearish, and want to see a 15 minutes break of structure. Does that make sense? You can write it on your chart just exactly this way. This is how I do it on my own personal charts. If we are bearish, I want to see a 15 minutes break of structure from this key level. So once price is in here, I'm looking for a break. If I don't see a 15 minutes break of structure, that means there's no trade. It just means that price is going to rally above the key level, blast through it, and continue higher. But if we see a rejection from this key level and a break of structure in the 15 minutes time frame, that means we're looking for sells on US dollar. So that means that every US dollar XXX pair will be looking for sells on it. Someone asked a question, why are we looking for USD card, a buy on the USD card? That is the explanation. If we are looking for a shift to market structure on US dollar from this key level, and if we do see that, it simply means that all the USD XXX pairs, we're going to be looking for sales on them. What are the US dollar XXX pairs? USD CHF, USD JPY, USD card, and whatever else USD XXX pair you trade, it means they're all going to be bearish. You're going to be looking for sells on all of them. What does this mean for XXX USD pairs? It means we look for buys. They are inversely correlated with the dollar. Euro is inversely correlated to the dollar. British pound the same. Oxy the same. NZD the same. They are inversely correlated to the dollar. So if you're trading Euro US dollar, NZD US dollar, GBP US dollar, it means you're looking for buys. If dollar comes into this key level and shows you a break of structure, this is what I mean in break of structure, a shift in market structure. This is it. We create a high, create a low, create a high, drop down, breaking the previous low. That is the break of structure. All we're looking for is a retest and a sell. Does that make sense? If it doesn't make sense, you can drop your question on the chart. And in the next live stream, I'm going to do the exact same analysis on euro. So you will understand the inverse correlation between the two. So I appreciate you all that tuned in for the live stream. You're all amazing. And I'll talk to you in the next live stream. Have an amazing day, everyone.